Everybody, welcome to this third European webinar in collaboration with CME Group. I would first like to thank CME for their continuous commitment to sponsoring CFA societies throughout Europe. CME, as you well know, is the world's leading and most diverse derivatives marketplace. This is the third webinar of the series we're organizing with them, but more will follow, so please stay tuned. And I would like to introduce our speakers today: Owain Johnson, Global Head of Research and Product Development, and Ian Caton, Manager of Metals Products. Owain's research and product development team develops new risk management products, as well as ensuring the continued relevance of key benchmarks. The team also produces original research into financial and commodity derivatives and their underlying markets. Ian, on the other hand, is responsible for the strategic development, management, and profitability of the company's metal business in the EMEA region. Since joining CME Group in 2015, Ian has covered a wide range of initiatives and areas from corporate finance to technology platforms. So all that I said means that these two people are really knowledgeable and experienced. We are really happy to have both of them here. They will share their views on the latest trends in oil and metal markets, and they will discuss, and dare I say, even dissect, if we are currently in the middle of a super cycle or not. So Owain, the floor is yours.
Well, thank you so much, and thank you all for your interest. I have to say, I do think it is a very interesting topic. We're getting a lot of questions from customers and from the media about super cycle, or should I say super cycle in inverted commas, because we're not sure yet whether it is a super cycle or not. Maybe you'll have more of an opinion after you hear what we have to say. Ian and I are strategically on the fence at the moment. We're trying to give you a balanced view. Before I start, I'll just mention a little thing about CME Group. So Alejandro, let's move forward. So CME is the world's largest exchange. Alejandro actually mentioned that. We cover all of the asset classes, financials and commodities, and the commodities is the area we're going to discuss tonight, obviously. CME began a very long time ago. It began, actually, you can see me in the background just there, writing on the screen. So, you know, this was when I was a much younger man. We began back in the 19th century. And sadly, that's no longer how it looks. It's all now computerized, and it's moved from the trading floors onto these big electronic platforms so that people trade it 24 hours a day. But it's the biggest platform for risk management on the planet. So that's us a little bit. So let's have a think about what a super cycle is, and we'll have a look at the different asset classes, myself and Ian, and we'll maybe hit a conclusion of some sort. But before we do that, I think we have a question for you, potentially. Yes, here we go. So, right, a basket of CME commodities that was 100, that's an index value of 100 in January 2020. Where are we now? So, answers, please. How are people doing with their answers? There's no penalty if you're wrong, and there's no prize if you're right either, sadly. Right, have we got a verdict?
So in a few seconds, just maybe one or two more answers.
There's a lot of people cheating, are they? Are they looking it up? No cheating, ladies and gentlemen. Ah, right. So the majority of people are saying 125 to 150. And we got a few, we got about a third of the people then at 150 to 175. All right, well, Alejandro, move on one slide and reveal the answer, if you will. Ladies and gentlemen, the answer is 175 to 200. Commodity values have doubled in the last 13 months on that basket basis. So that is why we are here today, because this is very, very bullish. That is a market that has obviously increased massively. If it's up around, we're actually about 185 on that index right now. So virtually doubled in 14 months, 13 months. So very bullish indeed. So let's have a look at why that might be. So let's think about what a super cycle is first. So a super cycle is something, it's not just a brief spike, and it's not just a brief spike in one commodity or two commodities, or even in energy or in metals or in agriculture. It's something that affects the whole of commodities. So if you look at the three super cycles that we've identified before, the first was the 1910s. The US was becoming a superpower. It was industrializing. There was a vast amount of investment into railways, into new developments, cities being built. So that drove commodity prices through the roof. The second one was the 1950s, when there was a huge amount of reconstruction after the Second World War. And particularly Germany and Japan were re-emerging as major economies. They were rebuilding dramatically. So you had a massive decade-long cyclical upside. And the third one we saw in the first decade of this century was really the growth in the BRIC countries, and particularly, I would say, within that China. So they were just, those countries were sucking in huge amounts of commodities as they went through a massive cycle of economic development. And those drove those super cycles. So if you have a look at that chart there, you'll see that this is how the early 2000s commodity super cycle began. And you'll see that actually ours at the present moment is going faster. So we are actually ahead of where that last super cycle was. So again, extremely bullish. You saw those numbers, 180 compared to 100 last January. So you can see that it's very bullish, but the jury's still out. You can see that was over 55 months. We're in months 8, 9 of this upswing. So it may stop tomorrow or it may continue. So let's have a little look a bit further. So a lot of commodities are driven by what's happening in the dollar, right? So most commodities, virtually all commodities, are priced in US dollars. So every time you get a weak dollar, that's bullish for commodities, because I have to pay fewer pounds, you have to pay fewer euros to buy the same amount of commodities. So we can afford to pay a little bit more in our currency, and it will raise the dollar value. So that's a very important factor. And we've seen a weak dollar recently, just because of the amount of stimulus that the Fed is pumping into the US economic system. So that is a big factor. Now, the question is, will that persist? Will the dollar remain weak? Will the Fed start to rein it in? That depends on your view of the US economy and your view of the stimulus packages that are being announced at the moment. What you think will happen to the dollar makes a massive difference to commodities. So that's a little different. We weren't, in those three previous super cycles, it wasn't so much about currency, it was just about raw demand. So this time, our super cycle, if we're in one, is a lot about the US dollar. Let's have a look at what else is happening. So you're also getting something different that you didn't ever have before, which is a focus on ESG, environmental and social governance, or sustainability. So a lot of people are saying this is the start of a new type of economy that moves commodity demand in a different way, because we are now moving, for example, from petrol vehicles to electric vehicles, and Ian's going to talk a little bit about that. Agriculture isn't just going into people's stomachs. Food crops are now also replacing gasoline in the form of ethanol, or they're replacing diesel in biodiesel. So you're starting to see more of an interplay, and that's bullish for certain commodities. Again, we'll come on to that a bit, but that's one of the things that maybe makes people think it's a super cycle, because you're just getting this giant secular change in the economy. There has to be an enormous amount of investment to move us from the economy we're in right now, with high dependency on carbon, into a lower carbon future. So that's another big factor that we're getting. Right. So let's move a little bit further on. This is just a little indicator we built out of a bunch of products to just show you how we're feeling. So you can see the dip in our commodity basket last April, March, February, because commodities were getting whacked by the pandemic, obviously. Factories were closing, people weren't driving around, people weren't building, people weren't doing their renovations. So there was a big pause. So you can see commodities dip. And then you get this opening up, slight opening up. And then as the economy opens up more and more and more, you're starting to see things building. So there's a strong correlation, really, between that cycle and the reopening of the economy. So again, some people will tell you this isn't the start of a super cycle. It's just a response to that weakness during COVID. Partly true. There's probably a bit more to it than that because, as we said, the dollar, the ESG, and so on. But certainly there is a correlation with that COVID slowdown. So just take a look at those numbers at the bottom. Best performance over the last 12 months, it's lumber. So that's wood, wooden material, gasoline and crude oil. Now, obviously, they were the worst hit, so they're the fastest to recover. And then we're seeing cobalt, gasoline, and steel. So those are products that are all doing really well at the moment. All right, let's keep going. So this is just for your time. If you want to take a look later, this is just a run through of various products and what that go into that index and what's affected them. But broadly, the energy was the worst hit by the pandemic and it's recovered the quickest. And the metals are doing really well at the moment. Ian will talk about that. And the ags are super strong at the moment. And a lot of that is Chinese demand. So we'll get into this in more detail. So let's move on and let's have a little think, I think, about specific asset classes. And we'll start with agriculture. And so here's a quick quiz before we get into agriculture. So lumber, wood, costs 200 to 400. So over the last 10 years, if you wanted a industrial amount of wood, you would be paying $200 to $400. What do you think you're paying now? All right, take a moment, have a vote. Let's see if you can get this one right, because it was pretty poor, the first question. I think we only got about 10, 15% getting it right. Let's see how we go. Come on, you guys, you can do it. Oh, very good. Very good indeed. Right, let us confirm that. Alejandro, do you want to move one slide forward? Yes, well done, everybody. The clue was in the previous slide, right? Lumber is the best performing commodity on the planet right now, or major commodity on the planet right now. Lumber is hot. Wood is hot, ladies and gentlemen. Right, so let's have a little think about agriculture. Let's move on to talk a bit more about the agriculture. So on the right, you'll see the chart is soybeans and corn. Now that is a hell of a chart, right? You can't get a more super cycle chart than that. It's going straight up in one direction. So what's happening there? You are able to see two things mainly. Firstly, the weather. So there's a La Nina at the moment. So that's a climatic event that is affecting South America, where there's a lot of agricultural output. At the same time, you're getting China massive imports once more. So you're getting hit on the supply side and on the demand side. And that's where you're getting that massive spike in soybeans and corn. Now, again, some people would say to you, that's not the start of a super cycle. That's just two temporary events. We'll have to wait and see a little bit longer, right? Maybe that Chinese demand is permanent. So let's have a look. Right, next one. Pork. So our friends the pigs. Pork is super bullish. Look at that red line there. That is really moving. So what's happening there? So I don't know if you remember, at the peak of the pandemic, a lot of the pork processing facilities were really badly hit. So they were really, really badly affected. And Tyson Foods, a lot of processing units were closed down. So there was a lot of impact there on the pork production. And at the same time, just like with the soybeans and the corn, China is importing massive amounts of pork because they have had big issues with pork swine flu, which is a very severe illness affecting the pork herd in China. So China's been sucking it in while the US has been slowing down. So let's keep going. There you go. Exactly what I was saying. Just a little bit of confirmation there. The US is really filling that gap from China, and that's pulling prices up. So again, is that a super cycle, or is it the impact of the pandemic on the US, or is it Chinese demand going to stick around for the long term? That's the bit that's not clear. So the length of this cycle, but certainly that chart is super bullish. Right, onwards. Well, you all know about lumber. You've become lumber experts in the last 5 minutes. So you all know the lumber price, but that again is a crazy spike there. So what's happening? Firstly, people are building again. So construction has restarted. People are back out. They can work together, so they're building. And secondly, a lot of us, we've been in our houses for a long time. We think, hey, you know, let's do some work around here. Let's do some do it yourself. Let's build the extension. Let's get the loft converted. Let's convert the cellar. Let's do some work around it. Big demand for lumber. And at the same time, Canada's been impacted by an illness in their pine crop, the pine beetle. So it's a bit like the pork and it's a bit like the corn. So you've had a problem again with the supply meets increased demand. So there's a lot going on there, but really look at that chart, because that chart is a 21-year chart. And you see that spike is incredible at the end. So again, look after your wood. If you have any wood, well done. You've timed it well. Right, onwards. And then vegetable oils. We talked a little bit about this at the start, but again, it's a story of Chinese demand meets weak Brazilian exports. So again, that's a 4-year chart, and you can see just that massive ramp up throughout 2020 and into 21. There's a little bit of a dip off at the end there. Maybe we're calling the end of that cycle, or maybe it's about to recover once more, but certainly it's so far above historic averages that it does really push that index of commodities up. Right. Is that at that point then, I'm going to hand over to Ian, because he's got a question for you on the metals markets. So Ian.
Sure. So this third question here, metals focus, and specifically we're looking at copper here. If you pull down your window, pops up right there. So how much more copper is used in electric vehicles and their charging points compared to internal combustion engine vehicles? Pause for a moment and allow you to answer, but the 3 or 4 rather options here are A, the same amount of copper is used, B, 2 times the copper is used, C, 3 times the copper is used, or D, more than 5 times the copper is used. We'll let those answers go in and see if we're trending in the right direction in terms of answering these ones right. All right, well, it looks like you guys are improving, because D is in fact the correct answer. If we progress on to the next slide, there we go. 53% of you got it right. More than 5 times the amount of copper is used in electric vehicles and their charging points compared to internal combustion engine vehicles. So it really underpins and what Owen was saying earlier in the presentation, that we're going to see this renewed and added demand on the metals side with a push more towards renewable and low carbon technologies. Okay, so this slide really provides an overview across the multiple groups of metals that fall within metals asset class. We really separate it into 3 primary groups: precious, base, and ferrous metals. As you can see, there are a range of different performances. Here, I did a similar thing that Owen did earlier in the presentation, where I've indexed the growth and performance of 3 different commodities that fall into precious, base, and ferrous metals to show the performance during the pandemic from when we first saw the lockdown set in back in March of 16. Gold being the representative from the precious group. Really, we see a stable trend here, and I'll get into why that might be. But it's being held up or by a low rate environment that's persisted throughout the pandemic. That contrasts with what we're seeing in copper, the base metal, representing the base metals group here. We see underperformance compared to gold, and then recently, specifically, you can see that inflection point in Q4 where both copper and HRC steel have outperformed gold through Q4 and year to date. Do you really see that change with stimulus coming online, focused on infrastructure? And as we mentioned before, the new kind of lens of infrastructure, what we're looking at, has a green tint to it. So there's added demand coming in, with challenges on the supply side being in South America. Chile specifically produces a lot of the raw materials, specifically copper, for example. There's lags in that supply meeting the new demand and building demand as the economies reopen. Progress to the next slide. So for precious metals, as I outlined before, we see that the stable performance over the course of the pandemic, really supported by a low rate environment. But why is gold so different than these other commodity products, and why is it an outlier? Well, we tend to think that gold behaves as a safe haven currency. So there's a store of value, there's a currency there. And when there's the threat of inflation, gold is supported. But when there's actually observed inflation, and in the context of a super cycle, and specifically where we are now, as Owen alluded to before, with a weak dollar, rising treasury yields foreshadow potential rate hikes. So when there's actually observed inflation, that's not so good for gold. So you see it kind of sitting in limbo, not underperforming or reducing, but relatively stable compared to those commodities with real industrial uses like silver, platinum, and palladium, which also fall into the precious category, but do have industrial applications. Like silver, for example, is used in solar panels and batteries. Platinum and palladium are used in electric vehicle batteries as well, and catalytic converters. So you really see them coming more into play than necessarily gold would, as gold is more of a safe haven currency, or viewed in that way without a specific industrial use, building it in demand as economies reopen. We talked about before how there's a range of performances with precious metals, and the separation there being their industrial application. Well, base and ferrous metals are specifically known for their industrial applications. So in the context of a super cycle, or in a supply disruption with demand coming back online, with the supply challenge to meet that demand, we really see that coming out and active in the price dynamics happening across base metals and ferrous metals as well, where copper is really seen as at the forefront of benefiting from our transition to a low carbon economy. It's a conductor and ideal for use in renewable energy systems like solar, hydro, thermal, and wind energy. Not only is it used in those systems, but it's a conductor, so it's used to connect those renewable energy sources to ultimately where it's consumed, whether it's at the household or in use of electric vehicles, which are excuse me, could you go back one slide? And really come into play as electric vehicles become more in focus, and the transition to that is a commitment from automakers. You can see just on the chart to the right here that open interest and positioning in our futures market really shows that this fundamental story is supported in the data, with interest building in our copper contract since the lows we saw during the pandemic. You really see that uptrend as far as positioning and activity and interest in our futures and options contracts. And aluminum and steel wouldn't be left out of the equation either. They also have applications within EVs, are used in the renewable energy systems, and stat right down here, 30% more aluminum is used in electric vehicles when compared to internal combustion engines. So that recyclability of metals is also another component at the supply level too. So you do have that green tint when you're sourcing, because you can recycle these metals and put them back into the supply chain. There we go. Not only are these more well-known and established commodities markets becoming more active in the context of economies reopening, infrastructure stimulus coming online, and in a push to a lower carbon economy. But also we're seeing less known markets like cobalt and lithium become in focus, and that's specifically because they're used as components in the batteries of electric vehicles. This demand is really coming from car manufacturers, fully getting on board with the transition from internal combustion engines to electric vehicles and committing to stop producing these internal combustion engines by the 2030s. So that's likely to lead to really underpin demand here. And we're seeing that show up. I mean, we've launched a contract in cobalt at the end of last year and are launching a lithium contract actually next week. And there was quick uptake in that cobalt contract, and hopefully we see the same in the lithium contract we're launching. And this graphic here of the electric vehicle shows kind of the broad-based impact of what the transition to electric vehicles does for metals products. So there's really new demand coming online, and again, I mean, supply is lagging behind, because as economies open up, this demand renews, and we have this stimulus also building out infrastructure coming online. So increased demand on the demand side, and really challenges on supply to meet that sustained demand from China, and then renewed demand kind of coming out from the low carbon and infrastructure stimulus sector. So I'll pass it back to Owen to start covering energy here before we wrap up.
Yes, so thanks a lot. So energy was one of the crazier years I've seen last year. I mean, we went all the way up, all the way down, back up again. Quite an incredible roller coaster ride, particularly for crude oil. Obviously, gasoline was the hardest hit, because gasoline is personal mobility. But refineries were also closing down. Jet fuel, you'll see there. So gasoline and jet. So jet and gasoline are the personal fuels, if you see what I mean. They drive individual activity in a way that gas oil or diesel tends to be used by trucks or trains, moving goods around the economy. So if the economy is producing a lot of goods, you tend to get that reflected in diesel. And so even down to things like people staying at home and ordering more from Amazon or online shopping, instead of you driving in your gasoline car, typically to the shops, you're getting someone with typically a diesel van bring something to your house. So the gasoline diesel was very heavily impacted by COVID and by lockdown. You can see gasoline after absolutely massively declining on the left there in March, April, May, starting to recover. Now look, you can see as of last month, it's still well below the historic norms that we were expecting. It's still a few points below, but that's a massive recovery from where we were. And as the US and other major economies are reopening more and more, you'd expect that gasoline to come back. You'd expect jet fuel to recover as well as people start to journey a bit more. Now, will jet fuel ever be quite as heavily required in such demand as it was pre-pandemic, or have people's travel plans changed permanently? That's a bit of an open question. A lot of companies are grappling with that, right? I'm sure you're all thinking, will we be traveling as much as we used to in the past? That's a massive, massive question for everyone that's producing these refined fuels, so for refiners particularly. But if you have a look at the bottom where it talks about things that have bottomed out, jet fuel is back up almost 80%. And obviously that's because it fell the lowest, right? So some of those numbers, it doesn't mean that it's back to normal. It means that it's shooting up because it's recovering from a very low base. So again, is this the start of a super cycle in energy, or is it just a recovery from a very low base? There's a bit of a debate there. I would say energy is the most problematic almost to debate, because all the things that Ian talked to us about, the growth of EVs, the move to sustainability, that actually has a negative impact on gasoline and diesel, obviously. So the super cycle for copper and for cobalt and lithium may cap or kill the super cycle for gasoline and diesel. Right, let's have a look at natural gas. So natural gas, again, you can see a huge upswing there. So why is that? Residential consumption is increasing again. Factories are back online and they're increasing their use of natural gas. So as the economy picks up, natural gas demand is picking up as well. So you're seeing that massive recovery from where we were at the start of 2020, at the middle of 2020 when we were really at a low point. And that is a combination of domestic and corporate. People are back air conditioning the office or heating the office. People are back running the factories at full speed. And a lot of that, particularly in the US and Europe, is powered by natural gas. Natural gas, you're also getting that environmental impact that we talked about at the beginning of some switching away from coal into natural gas. So natural gas generally is a bullish story because natural gas is probably the fuel that will underpin our move to a sustainable future, because people will have natural gas plant ready for when the sun doesn't shine or the wind doesn't blow. They'll have natural gas ready to go. So natural gas is much more, there's going to be a dependency on natural gas long term in a way there might not be so much on coal, for example. So generally natural gas has probably the brightest future of the traditional hydrocarbons because it's the cleanest. Right, let's just look at one other factor. So you can see what happened to crude oil production in the US. It was rising, bang, it's fallen amid the pandemic. It's fallen massively, dramatically in the second and third quarters of last year. So obviously, why is it fallen? Because prices fell, because refineries weren't producing as much gasoline and diesel and jet fuel, so they didn't need as much crude. And that backed in to the point at which people switched off their production, right? It moved from us not filling our cars back to the refinery, back to the crude oil producer. Now you're starting to see a bit of a recovery from those bits, or at least production is holding steady. And US production is holding steady at well above historic norms. So again, that's keeping some of the lid on prices because although OPEC is still been very disciplined, they've removed oil from the market when COVID hit, and they held that oil back now, even though economies are opening up. US production has that capacity, you can see, to go back up by another couple of million barrels. The difference between where we are now and where we could be, we know the US can get up to 13, and they're doing 10, 11 now. So if oil prices go too high, that production, that gap that you see on that chart will get filled again. People will go back out, they will drill, they will produce. So there's a potential there for further growth in oil supply, which could then impact on oil prices. So it's hard to imagine oil prices going to the moon while there's still this capacity that's ready to be switched on in the United States, big capacity. So that's what I wanted to leave you with on the energy side, where the picture is quite mixed. Is it a super cycle or is it just a recovery from an absolutely brutal 2020? And I'll pass you on to Ian to wrap up.
All right, so I am going to be very much walking the company in that line here with Owen, where we're not sure if it's a super cycle or a cyclical upswing here. It's way too early to tell from our perspective, but what we are seeing is increased interest and investment across commodity products. COVID's really flipped the script for us. So we're dealing with a whole new normal. It's a small sample size that we're assessing. So today we kind of outlined the trends we are seeing, the challenges we're seeing on the supply side, and the increased demand as we open up economies, as infrastructure comes into play from central bank stimulus, and there's that green tint on our infrastructure spend in the EV revolution and with decarbonization. So commodities always work in a cycle. it's up to everyone to decide where we are in that cycle and when we are in that cycle. So definitely something to track, and we are seeing price rallies, but too early to say if we're in a super cycle or cyclical upswing for us. So with that, we'll move on to the question section.
Thanks, Ian and Owen. So we have quite a bit of questions in the chat. Let's go ahead and start with the first one. So currently there are 7 internationally available Chinese commodity futures that are accessible via the Overseas Intermediary Program, copper, crude oil, etc. Speculation is rife on what will be made internationally available next by the CSRC. What commodity products would CME Group like to see China make available next?
I can start with that. We are always delighted to see these developments because, as you may or may not be aware, depending on how much you know about commodities, people like to trade commodities as spreads very typically. So they like to trade London gold against New York gold, North Sea crude oil Brent against WTI. They like to trade Matif wheat against Chicago wheat. Commodity traders love to look at spreads. So the more products there are out there that are liquid, the more liquidity there is generally in the commodity space. So we are always really happy to see that. And it also brings in new commodity players potentially. So there are people now that are interested in those commodities in China that maybe haven't looked at them before, because they can access that local market. Then there are people who will be able to arbitrage that local market against the international markets, which are often on CME Group. So we are really happy to see this development. It's great to see China opening up. We've seen really good response to their products. They are very influential now as price makers rather than traditionally price takers. I don't really have a huge opinion on what they should do next, and I wouldn't be so presumptuous as to give advice to them because they've been very successful so far. But I do understand they're looking at some of the other energy products, maybe natural gas, some of the refined products. Sure, those are going to be very successful. I'm sure they're going to lead to more hedging internationally. So, you know, bring it on. Very bullish.
All right, thank you, Owen. Moving on to the next question. Part of the commodities rise is a correlation to a weak US dollar. If the US is going to debase the currency, why would other major economies not do the same to remain competitive? Isn't that a zero-sum game? If the cycle is purely US dollar driven and not demand driven, how would that not last as long as last time we had cycle?
Yeah, again, that's a very good point, and I think we would totally agree with you. A currency-driven event will not be a super cycle. I think we can all agree on that. A demand-driven is the super cycle. Demand-driven drives the super cycle, absolutely. So those 3 previous super cycles that we talked about, every one of them demand-driven. So I think you're absolutely right that the currency is a big play now. If the currency changes in 6 to 12 months, then we won't get a multi-year super cycle. Absolutely right. And other nations, as you say, will control their currency. They will adapt accordingly. Currencies will find an equilibrium. And different nations, as they emerge from lockdown or as they deal with the pandemic in their different ways, they're obviously going to come through different periods of strength and weakness, depending on the speed of their economic recovery. So you will see some form of rebalancing there. But 100%, I think Ian and I both would agree with you that currency alone does not make a super cycle. It maybe accentuates what we're seeing at the moment, and it maybe helps to create the condition for the start of the super cycle. But if we're not seeing that demand, we won't see it last.
Thanks, Owen. So up next, do you think steel and scrap will stay a very fragmented market with low volume and liquidity, or do you think the market will consolidate around 1 or 2 particular references, CME Steel?
So I'll take this one, Owen. So we've already seen that start to happen with the U.S. Midwest HRC steel contract that CME offers. Over 33 million notional trades on a daily basis on average, and we were approaching 1 billion notional in open interest in that contract. So we've seen consolidation around that CME reference point for steel. And it's really the most liquid contract outside of APAC. So for Western traders there. But there is going to be that regionalization with all these different scrap grades and tariffs and whatnot, and need for regional pricing to get precise hedges done. But we've seen a lot of consolidation, and actually you can see it on the Commitment of Traders report, where we're attracting a wide range of customers, not only physical players, but the investment community is starting to become very active in the U.S. Midwest steel price to gain exposure there. So it's roughly 26% of open interest there is held by managed money at this point. So it's definitely starting to consolidate, still at early stages, but it's approaching the threshold where we are getting a wider range of players into that market.
Thanks, Ian. So coming up next, you mentioned a good take-up on the cobalt contract. What is the market depth like? And are there many actors, or is it very specialized players?
So currently, the cobalt market is mainly transacted via voice and then cleared on exchange. So the depth isn't as visible from a screen perspective, but what we do see is transactions happening on a weekly basis now, and open interest out through 2022. And the players that are in the market are facilitating transactions for the broader community. Now, what that means is there are a few sophisticated players that are dealing with either European automakers or on the production side that are transacting it and starting to hedge in the market. So that's very common in the early stages of what we see in these developing commodity markets. I mean, we saw a similar thing with hot rolled coil steel in the early stages of that development, where you see open interest starting to build up. Trades going through in strip format, where it's either a quarter or an annual strip, and that open interest building to the point where then you get a broader range of players into the market and starting to see screen trading develop in that physical market.
Thanks, Ian. So do you think the continued rise of EUA prices could harm the recovery of or demand for gas in Europe? EUA prices could make gas power stations uneconomic, and then in parentheses, if they aren't already.
Oh, that's a tricky one. I think there's no doubt that this EUA prices are problematic for European competitiveness relative to other regions. And I think that's why we're getting more and more of this discussion of a carbon border tax or a carbon border levy, which is a very interesting idea. What you don't need in Europe is to see production facilities move outside the bloc to take advantage of the lack of emissions. That just doesn't help anybody in any way, doesn't help the planet, and it doesn't help Europe as an economic area. So I think the idea of trying to equivalize some of the carbon impact is a really interesting one. And we're watching that very carefully, because although obviously anything that impedes a free market is less than ideal, it does seem unfair if you can just move 5 kilometers down the road outside the block and emit as much as you like with no penalty. That doesn't seem like a viable solution long term. So I think there's a lot of work going on at the moment, and that's something we're watching very, very carefully. It's a really fascinating debate. It's a really fascinating debate, and I think it's going to change a lot of trade flows potentially like that.
Thanks, Owen. So up next, everywhere I look, I see high prices: equity markets, bond markets, commodities, Bitcoin. Is there something special going on in commodity markets, or is there just too much money out there?
Well, I'll start, and then maybe Ian can weigh in. So you're right. You know, there's a lot of money out there looking for a home, and you are absolutely correct that a lot of assets are trading at very high levels at the moment. So absolutely, totally agree. I would argue that, and hopefully you've heard this evening, that there are some special things happening in the commodity market. So we talked about the dollar. We talked about the move to sustainable economy, which is obviously leading to massive new investment in infrastructure like charging for electric vehicles. We talked about Chinese demand recovering. China is really backfiring. You've seen the GDP numbers, they're huge. So you're seeing a lot of a lot of demand stimulus from China, pulling in those agricultural, metals and energy commodities at the same time that we've seen some disruption on the supply side. So timber, wood, lumber is a good example. That's not somewhere that the hot money goes. That's not a market that has financial players in. And Ian described lithium and cobalt to us as well. Those aren't markets where speculators are investing money because they think there's good returns and those prices are going to surge. Those prices are surging on trade between natural consumers and natural suppliers because there's an imbalance in supply and demand. And it's the same with our pork and our livestock markets that I showed you before. The pork markets aren't full of banks and hedge funds and investment agencies looking to make fast buck. The prices are rising there not because there's a wall of money coming in. The prices are rising because of that supply-demand imbalance that we talked about. So I do think, in general, yes, there's prices are higher across the board. But if you look at those specific commodities that we've talked about, there's a real reason behind that.
Yeah, I just reinforce that too, especially with markets like cobalt, but like Owain mentioned, it's primarily physical. And so a lot of these physical markets that we're seeing are still rallying in prices due to the supply and demand dynamics, renewed demand coming from the whole range of factors that we outlined in the presentation, along with challenges on the supply side. I mean, if you think about supply just trying to turn right back on and meet this demand, it's difficult if it remains flat. And now with this added pressure from renewed demand, it certainly causes an imbalance there. So fundamentally, you can see it's not just kind of more money injected into the market. There are kind of disconnects from a pure fundamental standpoint as well, driving these rallies.
Thanks, Ian and Owain. So we do have a few more minutes if we want to take maybe one or two more questions. Yep, so coming right up. So there seemed to be a particular spike up around the end of October, beginning of November period across assets, including commodities, then continuing into 2021. Any idea if there were some specific events that led to this?
I think the biggest one, honestly, is the rollout of vaccines. The start of the news. Well, even before the rollout, people were trading the news. So commodities always, front run. The prices front run the actuality. So, people are bidding copper up because they think there will be an EV revolution in the next few years rather than it's happening just right today. And similarly, people piled into commodities because they knew that the economies were reopening, at least the US primarily, and then to a lesser extent, some of the European economies. So I think that news flow, the positive news flow, was a massive impact. So people tried to get in ahead of a trend. You could see the trend, so people front run the trend there, and they jumped in early before, and it took really the actuality was probably more like Q1 this year, but people were positioning themselves ahead, and you just haven't seen that disappear. That's just kept on. It's become then a bit of a virtuous cycle for prices as people start to trade the momentum of those prices rising.
Thanks, Owain, and thanks, Ian. So I'll go ahead and give the floor to Alejandro for concluding remarks. In case you do have other questions, feel free to email us, and we'll be sure to forward them to our speakers.
Well, thanks a lot, Owain and Ian, for sharing your time and knowledge. It has been a great event. It has allowed me at least to learn a lot more about lumber, which is clearly something I did not expect today. So thanks for that. The recording and the presentation will be available for all participants. I'm speaking to the participants right now. There is a link on the to the survey in the chat. If you can take please a couple of minutes to rate the speakers and to rate the event. Your feedback is really valuable for us. I think that we can all agree that it was a great event, so hopefully we will get good feedback. But if it's not the case, please let us know. It allows us to build better events. Talking about the events, we have two next webinars coming in on May 4th on soft skills. We will learn how to how to do remote presentations in more impactful. And on May 20th, there's a webinar on climate change on the new disclosures for banks. Until May 4th or May 20th, and even until the summer, please stay safe. This is the most important thing. And again, a real pleasure having both Owain and Ian. Owain, your joke makes me laugh every single time. Hopefully, I will listen to it with great pleasure a third time.
In person next time, hopefully.
Hopefully in person, yeah, it's still working. So yeah, I think it was a real pleasure organizing the events with you. Hopefully we will have you back soon. And yeah, as always, please stay safe. And thanks for joining.